Let's talk about partnership financial management. The financing structure gets you into the property, and financial management keeps your partnership functioning smoothly. First, set up a dedicated joint bank account. Before you close on the property, ideally before you even make an offer, set up a bank account that exists solely for your JV business. All rental income goes in, and only property expenses or partner dividend payments come out. No personal transactions ever. Commingling personal and JV finances creates accounting nightmares, makes tax filing unnecessarily complex, and creates the conditions for partnership disputes. A dedicated account with both partners having access, with defined spending authorities per your JV agreement, is the clean, professional approach. Both partners should be able to see the account balance and transaction history at any time. Transparency in finances is the foundation of financial trust in a partnership. Next, the handling of ongoing financial contributions. Most of the time, rental income should cover operating expenses, but sometimes it doesn't. For example, a vacancy period, an unexpected major repair, or a strata special assessment. When that happens, how do partners contribute? This needs to be decided in advance. What's the trigger for capital calls? That is, requests for additional partner contributions. What's the timeline for partners to contribute? And what happens if one partner can't contribute when called upon? Document this in your JV agreement. Having the conversation when there's no crisis is far easier than having it in the middle of one. Next up, cash flow shortfall and surplus management. What's your shortfall protocol? What expense category gets reduced or delayed first if cash flow is tight? And what's the minimum reserve balance you maintain before partners take any distributions? And what's the surplus protocol? When cash flow is positive, how much stays in the account as reserve before profits are distributed? And what's the distribution schedule? Is it monthly, quarterly, or annually? Build a minimum reserve threshold into your operating agreement, a floor below which the account balance can't go before partners are asked to contribute additional capital. I recommend at minimum of 2 to 3 months of operating expense, but some hold more just to be safe. Base it on the partnership's judgment and risk tolerance. Next, let's talk about tax implications. Know what you're walking into. Rental income is taxable in Canada. Each partner typically reports their proportionate share of the JV's net rental income on their personal tax return, the amount after all eligible expenses are deducted. Eligible deductions for Canadian rental properties include mortgage interest, not principal, property taxes, insurance, maintenance and repairs, property management fees, accounting fees, advertising costs for tenants, and depreciation, capital cost allowance in some circumstances. The CRA has specific rules about rental income reporting for partnerships and joint ventures. Use an accountant familiar with Canadian real estate investment. This is not optional. It's the cost of doing business. And the tax savings they identify typically far exceed their fee, which you can write off the following year. Now let's pivot to the homework for this lesson. Financial management system design. Create your blueprint for JV financial management, including bank account setup, contribution protocol, minimum reserve threshold, distribution schedule, and monthly reporting format. By the end of this exercise, you'll have a functioning financial management plan ready to share with your partner.